Right now, trading well above or comfortably above 4,000. As you can see, this is a fresh 13-year high after it crossed 4,000 for the first time trading yesterday. So will the momentum hold, and how should you position your portfolio now heading towards the end of the year? Quincy Crosby is a market strategist with Prudential Financial, which has $1 trillion under asset management. Alan Lancz also joins us. He's editor of the Lancz Letter. Alan, what are you telling investors now?
Well, I think it's a matter of getting in the right areas. I mean, a year ago, Simon, everybody thought super value was uncompetitive. The stock was down to $2. Best Buy was just as far as showroom for Amazon.com, and Nokia, everybody was writing off. Those three stocks are among the best performers this year. And I think you could see the same thing. Instead of chasing the Teslas, and many of the companies have done so well, what we're telling our investors is, buy, where there's value and lesser risk, where you still can get good appreciation. And we see that like in a Nuance Communications, which is hitting a new low, healthcare REIT, and also a company like CompuWare. But the latter two yield 4.5% to 5.5%. So I think those are good places to be in a market that's getting fully valued, if not slightly overvalued.
Well, we kicked off talking about the NASDAQ. The NASDAQ surge has, of course, been driven, as you infer, by the likes of Tesla and Netflix. And we've seen the temptation to book profits on those winners so far. Are you really against people holding those stocks? Would you go as far as to say they may be in bubble territory?
Yeah, I think they are. We haven't been bold enough in our long-short portfolio, Simon, to short these, just because there's crazy momentum involved, and you get that emotion with investors. So I still think they're too risky to short, but we definitely wouldn't own them as far at these levels. And profit taking is warranted, and I would invest in the companies that have lesser expectations and therefore lesser risk.
Quincy, is he right?
Well, it's very difficult. I mean, it's risky to be in, it's risky to be out of the market right now. December is probably the sweetest spot for the market all year. It is the best performing month of the year. And so momentum can continue, but what you're going to see happen is, as managers, hedge fund managers, mutual fund managers make their performance numbers, they'll start to lock in so they don't jeopardize that performance. But I will say that it is definitely a momentum-driven market.
Hang on, Quincy. Hang on. Now you've confused me, because you started off by saying December is usually a good month. The market rallies, and then you're saying to me, actually, some of those big fund managers might lock in profits, which means they'd be sellers, which could bring the market down. So I'm not sure where you're taking me.
No. They're not going to necessarily sell. They'll put hedges on their portfolio. But the point is, you can see from the credit market, the 2-year swap spreads have really collapsed. It's telling you that this is a market that is still risk on. And until you have a change in landscape, most managers do not want to fight it. So you've got the financials doing well, you've got the high beta names doing well, industrials doing well, you've got consumer cyclicals doing well. It is telling you it is a market that wants to keep December in positive territory. Statistically, it is a very good bet. But again, you're going to see derivatives used in this market.
Well, yes, that also is the case. Alan, I just want to, the simple strategy for stock investors here could have just been follow the buybacks. Do you think that continues next year?
Yeah, I think so. I think, try to reduce risk, take some money off the table. I agree with Quincy. The market, the momentum is there. The market is probably going to head higher, maybe even through March, through tapering. But there's just more risk as it moves up, and therefore, stick with companies that are buying back shares, stick with companies with good balance sheets. And if you can get those, like I mentioned, that are trading near their lows rather than reaching and are at historical highs, I think you've just lessened the risk right there, and you can still ride the wave of the market.
Have a great Thanksgiving, guys. Thank you for joining us. Alan Lancz there and Quincy Crosby. Enjoy.
You too.